Okay, the fourth part is about default risk. Default risk is the most serious risk in investing bonds. Default risk is the risk that issuer does not pay back. So you lose everything basically. So we need information about this default risk because default risk is one of the biggest risks that determine our yield to maturity. So Standard & Poor's, Moody's, and Fitch actually grade each bonds based on their rating system. So their rating system is actually looks a little different, but it's pretty similar actually. So very high quality bond is AAA and AA bonds, just notation may be different. And high quality is the A and AAA, and up to this part, this is investment grade bond. And below this BBB part, this is junk grade or non-investment grade. I mean, Moody's and S&P actually has the subcategories in each category into three parts. So S&P used the plus and minus. So A plus is the strongest A rating, and A minus is the weakest in A rating. Moody's use 1, 2, 3, and the A1 is the strongest in A. A3 is the weakest in A. So I mean, the way they actually categorize the same. The important bar is here, like a BBB is the lowest. So BBB minus is actually lowest investment grade bond. Once the bond become junk grade, then the yield substantially increases because many investors don't investing in the junk grade bond. Again, who determine? This is determined by the credit rating agencies, Standard & Poor's and Moody's in the United States, the Fitch in Europe. So how to determine this? There are a number of ways. I mean, this is not the only factors that you have to watch, but these are kinds of the things that the credit rate agencies may see, and the kinds of proxies that determine the safety of the bonds. So the coverage ratio is the ratio of companies' earning to fixed cost, usually interest. So for example, the times interest earned ratio is the ratio earnings before interest payments and taxes to interest obligation. The fixed charge coverage ratio includes the lease payment and sinking fund payments with interest obligation to arrive at the ratio of the earnings to all fixed cash obligations. Lower or falling this coverage ratio signal the possible cash flow difficulties, right? The leverage ratio is usually debt to equity ratio. Too high leverage ratio is dangerous. Liquidity ratio, the from need to liquid, the current ratio, quick ratios are two typical way to look at. And if the current ratio is below 1, then that's trouble. Profitability ratio, you measure the return to ROE, ROA. If company is not profitable, that's bad. And cash flow to debt ratio, obviously, is the total cash flow to outstanding debt. You won't have enough cash flow to cover that, right? So you have tendency, like a consistent tendency from the AAA to CCC, which is from the very best to the very bad one, actually, right? This is average of each ratio, and the tendency is pretty consistent. So one way to see the default risk is looking at the related ratios in financial statement. So in bonds, there's a indentures that includes the provisions of the bonds. They're usually related to the kinds of some restrictions to the issuers because the buyer, the bond investor, want to at least keep the risk level same. They do not want to increase the level of the risk of the company. So in contract, there's called a sinking fund. The sinking fund is the kinds of preparation of the funds to pay back the balloon payment and maturity date. So maturity date, they basically have to pay a lot of money, and the sometimes the bond in bond indenture, there's contract saying that the issuer should set up the sinking funds. There are a couple ways, the firm may repurchase a fraction of outstanding bonds in open market each year so that they can actually be prepared. Number two, the firm may purchase a fraction of outstanding bond at a special call price, right, associated with the sinking fund provisions. So not in the market, but in the sinking provisions call price, the firm has the option to purchase the bond either at the market price usually, or sinking fund price, whichever is lower, because the company wants to take the benefits. To allocate the burden of sinking funds call fairly among bondholders, the bond chosen for the calls are selected at random based on the serial number. Okay. Subordination clause is the restriction on additional borrowing, stimulating senior bondholders paid first in the event of bankruptcy, which means that, well, so I don't want others actually have the seniority in the liquidation. So they basically set a clause that, well, you can borrow more money from these senior holders, possibly. Collaterals, just collateral securities. Debenture is the bond without securities. Okay, so that these are usually from the indentures, the provisions that avoid the default risk. Stated yield is the maximum possible YTM of the bond. So let's look at the example. Suppose a firm issued 9% coupon 20 years ago. The bond now has 10% yield left, so it becomes 10-year bonds, but the firm is having financial difficulties. So you believe that you cannot collect all the money. That's a problem, right? Investors believe that the firm will able to make a good of remaining interest payments, so they can pay interest, but probably not everything at maturity date. The firm will be forced into bankruptcy and the bondholder will receive only 70% of the par value. The bond is selling at $750. So if you calculate the YTM, you have coupon payment, number of semi-annual payments, and final payments. Now this is stated YTM, right? So $1,000, 750, calculate that. The stated YTM is 13.7%. Now this is the maximum yield. But in fact, you don't get $1,000, you may get just the $700. Then what happens is recalculate expected YTM because of financial difficulties, and you get 11.6% yield, which should be lower than the stated yield. So stated yield should be the maximum possible yield that the bond you have. Default premium. So when you require returns, then one of the biggest portion is the premium from the default risk. If the default risk is high, then you require higher yield, obviously. So example 10.14, suppose that the condition of the firm in example 10.13, the previous one, deteriorates further, so to have more problematic, and investor not believe that the bond will pay off only 55%, not 70%. Investor now demand expected yield to maturity 12%, which is 0.4% higher in example. Because why? Because the default risk increases, so the price should decrease actually. So the price will fall 752, 688 because the required rate of return stated yield increases, right? So at this price, the stated yield to maturity based on the comprised cash flow is 15.2%. Now, while the expected yield to maturity has increased by 0.4%, the drop in price has caused the promised yield to maturity to rise by 1.5%. So if the default risk changes, then you require more default premium or less default premium, the price bond changes too. This is another way to, another factor that changed the price of the bond, not just interest rate, but also the probability to be default. If the probability to be default increases, then you require higher default premium, then you have lower price basically. This is yield spread between the corporate 10-year bond and the T-bond. So suppose T-bond is, say, I mean, it's not risk-free, but it's very close to risk-free. So suppose just the T-bond is a risk-free asset. Now, the lowest part is the AAA, the second part is BBB, and the DC is high yield. So it's a junk bond. And this spread increase a lot when economy is bad. This is the Great Recession period. This is dot-com bubble period, right? I mean, we have consistent changes, but in risky situation, high yield spread is a lot higher than lower yield bonds. So this is one indicator of the economic situation. The next one is credit default swaps, CDS premium. So TDS, the insurance policy on the default risk. So you can actually buy insurance policy for the default risk of the certain bonds. And the premium on this CDS is actually also the degree of the default risk. So if the CDS premium is high, then the default risk is high because you have to pay high price for the bonds that protects, I mean CDS that protects to the against the default on the highly possible default bonds, right? So if you see the Greek 5-year sovereign CDS, Greek government bond spread, they go together actually. They move together because the risk level, basically these signals, these two measure all signals the current bond situation, the situation of the bond default risk. So the spread high, then the situation worse. You have high possibility of default, then CDS premium increases. Okay. So this credit default swap premium is one measure, another measure of another signaling measure actually of the economic situation. So this is part 4. Next part is about yield curve. So see you next part.